So what if the world's most important financial institution was about to get turned completely on its head? In this explainer, we're diving into a pretty startling 2026 forecast that sees a great disruption coming for the entire global bond market. Okay, let's jump right in with the most provocative question from the analysis, one that really sets the stage for everything else we're going to cover. It hints at a massive, radical shift in how the world's most powerful economy could be run. And this quote, right here, this is the heart of the whole thing. Analysts are looking at this as a kind of litmus test, a clear signal of the intense political pressure that could fundamentally change the independence of the U.S. Federal Reserve. This pressure leads to a really critical scenario that analysts are exploring, what they're calling a Trumpian Fed. So let's break down what that could mean for the economy, for inflation, and, ultimately, for your investments. And that brings us to this really important term, fiscal dominance. This is the core fear that the analysis highlights. Basically, it's the idea that the Fed could be pushed into prioritizing cheap government borrowing, funding spending, instead of its main job, which is keeping inflation under control. And get this, the forecast suggests this massive policy shift could all be triggered by just one person. The analysis points to Kevin Hassett, a known loyalist, as a potential next Fed chair. The big concern is this could lead to this crazy level of coordination with the Treasury, all aimed at cheap government funding. And the result? A Fed that's always playing catch-up on inflation. One analyst literally just called the whole scenario spooky.
Okay, so now let's see what happens when this political story collides with what's actually happening in the U.S. economy. Because at the exact same time the Fed is facing all this pressure, the economy itself is showing signs of heating up. A lot.
Analysts are pointing to this powerful three-part cocktail that's expected to fuel both growth and inflation in 2026. So first, the drag from tariffs is fading away. Second, you've got a whole new wave of stimulus, like the One Big Beautiful Bill Act, and these potential tariff rebates, which puts more money right into people's pockets. And third, tougher immigration policies are expected to shrink the labor supply, which could really push wages higher. And right here, you can see the dramatic reversal that analysts are forecasting. After a pretty strong year for U.S. government bonds in 2025, the prediction for 2026 is a massive swing in the other direction. We're talking yields marching higher, maybe even past 4.5%. It's almost like we've seen this movie before. Analysts are pointing to what happened in Australia, where a very similar story played out. Inflation roared back, the economy kicked into a higher gear, and bam, bond yields just shot up. It's seen as a possible roadmap for what could happen in the States. But here's the thing. This U.S. story doesn't just happen in a bubble. The potential turmoil over there sends ripples all across the globe, and it's creating a world of divergence, where different parts of the world are heading down completely different paths. And this is a perfect example of that split. On one hand, you have the U.S. facing high inflation risk and all this political drama. But then you look at the U.K., and it's a different story. Inflation is cooling faster, and they might even get rate cuts. So you get this stark contrast, where the same things hurting U.S. bonds could actually make UK government bonds, which are called gilts, look pretty good in comparison. Meanwhile, Europe is telling a tale of resilience. The forecast sees growth bouncing back thanks to German stimulus and those big EU recovery funds. So yeah, European bond yields are also expected to rise, but for a much healthier reason than in the U.S. It's being driven by actual economic strength, not just political worries and inflation fears. And finally, let's swing over to Japan, where the market might have just gotten a little too excited too soon. The Bank of Japan is finally starting to normalize its policy, which is a huge deal, but some analysts think the recovery is still pretty shaky. They think bond yields have climbed too high too fast, and that could set us up for a pullback in 2026. Okay, so that's a lot to take in, right? A totally split global picture. So what is an investor supposed to do with all this? Let's look at the key takeaways from the analysis for the year ahead. So the whole analysis really boils down to these key strategic moves. The big picture view is to be underweight global bonds, which just means holding less than you normally would. They're especially bearish or pessimistic on U.S. Treasuries. But on the flip side, analysts are long on European stocks, thinking they'll do well, and they also like the U.S. dollar for shorter-term tactical trades. And here it is. This is the number combo that underpins that whole bearish view on U.S. bonds. The forecast is calling for 2.5% economic growth, which sounds great, right? But it's paired with 3.2% inflation. That mix is just way too hot for the bond market to handle, especially if you have a Fed that might not be allowed to step in and fight it.
So when you look at everything, this entire forecast really hinges on a huge, maybe even an unprecedented, change at the very heart of the global financial system. The analysis predicts a great disruption is coming for the Fed. And that leaves us with the single most important question for 2026. What if they're right?